Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it's my pleasure to be your host for today's episode. In today's episode, we'll be looking at what happened over September 2025 and be discussing the outlook again, looking forward. This podcast is being recorded on Wednesday, the 1st of October 2025, and joining me again today is our Chief Investment Officer, Rob Hogg. Hi Rob, welcome back again.
G'day Steve, how are you? Good to see you.
Very good to see you. It's been an interesting month. The markets have been a little bit up and down. The Australian market was a bit down, the US market was a bit up. Can you talk through what happened in the month?
So it was a month where what happened in Australia was a little bit different to what happened elsewhere. So look, the US, the S&P equity market up about 3.5%. And most other markets around the world were up a couple of percent or so for the month. They broadly rose through the course of the month, and a number of markets again reached record highs. Now, Australia was a bit different. The broader market, so the ASX 300 accumulation index, looks at the total return of the broader market. That actually slipped by a little bit over 0.5% for the month, so in marked contrast to what we saw globally. Small companies here did better than that. They were actually up around 3.5%. And the other thing that really made Australia stand out was really the magnitude of the move in shorter term interest rates here. And look, I think the two are connected. The rise we saw in short term bond yields and the weakness in the broader market, I think they're connected, and we'll talk about that. The only other thing I think worth mentioning is just the gold price, up another 10% in September. It's getting up to close to an increase of 50% year to date. An incredible run continued.
And look, not wanting to be too proud or anything, but it does look a little bit like small companies have started to come back, and you mentioned that small companies in Australia have started to outperform. One of our key focuses at SGH is on small companies, and our small companies trusts did incredibly well, 13% plus, up over 20% in one case. I really think now is the time to look at small companies. They've underperformed for a long time, and I'm sure we'll have more to say about that in coming months, Rob. Today, let's have a bit of a chat about some of the things that happened in September. One of the things you've been talking about recently is the current market consensus of earnings and rate cut expectations and so forth, and risks there.
I guess what we really want to emphasise is just, if you think about the setup, the market setup. So today, as of today, we're talking about the US here initially, market expectations are that the United States Federal Reserve, so the central bank, will cut rates another couple of times this year and then a couple of times moving into 2026. So that is the market expectation. That is built into not only interest rate pricing, but it also has an impact in equities. And further than that, and built around that, is an expectation that the US economy will soft land. We've seen a little bit of softness, particularly in the employment market, and the expectation in forward market earnings and so on is that weakness will likely to continue but won't be significant. And that sort of soft landing, which is what that sort of implies, together with rate cuts, that's generally a pretty positive environment for equity markets, risk markets more broadly. But that's exactly what's priced in today. So as we sit here doing the podcast today, that is what the market expects. So there are risks around that. One of the ones we've been talking about for a while is the inflation risk, because inflation pressures need to ease for the Fed, the US central bank, to continue cutting rates. Now the catch is, and this happened again in the last month, is that underlying inflation momentum is continuing to edge higher. It's not rocketing, but it's not going down. It's edging higher. So were that to continue, that really constrains what the Fed can do. And harking back, market expects them to cut rates like another 4 times. If there's anything that prevents them from doing that, like inflation, that is a potential risk to this consensus. The other one, on the other side, is that rather than a soft landing, in fact, we get a nasty downside surprise, perhaps with something like employment. So if we were to get a monthly payroll number that was negative, that could potentially be the beginning of a trigger to make the market reassess its sense of soft landing. In other words, if the probability of recession starts to rise in the market's mind, that is definitely not priced in. So higher inflation constraining the Fed is not priced in, and a nasty downside surprise with growth, perhaps exhibited by weakness in employment, that is not priced in. So we're walking a narrow path where in many ways the best case scenario is currently priced.
Is the threat of a government shutdown a trigger? In the past, it's been a short-term trigger, but it tends to bounce back quickly.
Yeah, it does. And in fact, if we look at market performances around the time of government shutdowns, they're as many times positive as negative.
Yeah, okay.
I don't know, perhaps it'll be different this time with the current administration, who do like to play hardball more than other administrations. And some of the pronouncements we've had from the President just in the last day or so about really taking advantage, not exactly the words, but really taking advantage of a government shutdown, that could have a more significant, potentially negative effect. But as we sit here today doing the podcast, we're only in the very early hours of a potential.
Yeah, and time will tell. Sometimes these things are resolved pretty quickly. So you and I have seen quite a few of these shutdowns,
We have seen
Rob.
a few of these shutdowns.
So we know they always reopen, but it's just what happens in the meantime.
Yeah.
Brilliant, thank you for that. So just looking at the other month's major developments, one of them was that the US central bank cut rates. To the extent that we haven't talked about it, can you just quickly review that?
Yeah, so yes, they cut rates as expected. What's important with these actions is the surrounding statement. And I think the statement and the size of the cut at just that minimum, 25 basis points. The statement as well describing it as risk management, but also talking about near-term risks to inflation tilted to the upside. That was, I guess, what you'd call a hawkish cut. And by that specifically, the market was a little bit disappointed, and we saw really from that day on, market interest rates rose. There wasn't too much damage done to equities, although they were a bit weaker on the day. We saw more of the impact in interest rate markets where, as we marched towards the end of the month from the Fed's decision, rate cut pricing, whilst remaining, just edged fractionally lower through the rest of the month.
So the expectations of forward rate cuts being wound back. You said before that maybe the best case scenario is being baked in, but perhaps there's a tiny bit of caution?
Yeah, there is. And the market performance we've seen for the reasons, that being the near-term risk to inflation, if that were to continue, we will see more and more of these rate cut expectations wound back. And that is a risk to this very positive macroeconomic scenario that the market has priced in.
Okay, so in a nutshell, slight concern on inflation. I guess less bullish about the projection of interest rate cuts, and US growth momentum is slowing, and that's not a good thing. So the spectre of stagflation has not disappeared.
No, it hasn't. But we have suggested that this could be an environment into which the US moves, but so far it's managed to avoid that. Growth momentum slowing, yes, but only ever so slowly, and the economy is still expanding. And inflation, yes, it's moving up, but again, ever so slowly. So we're really talking the risk being an extrapolation of these trends that have been in place for some time. But I think if anything, the market continues to be surprised by just how slow these trends are occurring.
Okay, let's talk about AI. It wouldn't be 2025 if we didn't talk about AI again. It's again been a key driver in September in the US. Can we talk about that?
Yeah, so NASDAQ index, about the best performing major index in the US and one of the best in the world for that matter in September, up around 5.5%. And look, a lot of this is back to the whole AI thematic. So it's all of the capital expenditure that the market expects will be needed to facilitate the compute power required for AI. So that's, as we all know, the thematic. And that's been a very important driver of equity market returns, not just this year, but it came back with a vengeance in September. And interestingly enough, we had during the month another report or another research piece that sort of questions some of the blue sky that's built in. So in this particular case, last month, Bain Consulting released a report, in fact their annual global technology report, and really what they were talking about was the fact that the expectations for the amount of compute power required is going to cost such an incredible amount that it's hard to imagine industry being able to actually allocate that amount of capital to capex of this nature. The other thing that's important is just how key tech capex has been, even this year. Over the past year, AI-related capex has grown by 15% in nominal terms, and in the first half of this calendar year has contributed around half a point to overall GDP. So it's already making an incredibly powerful contribution. Now, why is all of this important? For a couple of reasons. One, will industry actually have the capacity to invest in line with expectations? But two, will the return on that capex meet what is required to make the capex investments in the first place? So anything that should question either of those two elements of the story could lead to a revision of expectations in related to the whole AI thematic. So this is not saying AI is going away at all, not saying it won't be incredibly transformative. All it's saying is that can the investment that's expected actually occur in the volumes required, and is the return on investment going to be what investors today are currently expecting?
And not to sound like a 60-plus-year-old historian here, but if you go back to, and you mentioned the dot-com boom, the market got very excited about it, and it was right. The internet transformed the way the businesses did business. However, the valuations and the capex involved at the time saw companies collapse because they weren't able to deliver on their capex that they spent. So the issue and the concern I've got is that, yes, AI is going to transform the way the world does business, but are the current crop of AI beneficiaries going to necessarily be the ones to invest in for the next 20 years? It may not necessarily be the case, and we may see some fallout, Rob, which is what you're kind of saying, right?
Yeah, it can just be a very slow burn. We can be having this same discussion for months and months. And back in the 1990s, as you and I both remember, these discussions went on for months and months.
They did.
It was 4 or 5 years before the year 2000, I think, that Alan Greenspan, the chair of the Fed at the time, spoke of irrational exuberance. That exuberance can go on quite some time.
Okay, let's talk about Australia. Obviously, the central part of our portfolios, acknowledging obviously that the US and the world has got such a big part to play in what we do. The monthly inflation figure, how has that weighed on the hopes that we have for rate cuts in 2025? There's been a change.
I think Australia's a really interesting example of what we might see globally. So monthly CPI around the middle of the month for August, it's fractionally more than expected, but really not a lot. But as is often the case with stats, it's not the headline that's always the most important thing. It's what contributes to the outcome. And in this particular case, during the August CPI anyway, what was really driving this very slight upside surprise was a thing called inflation in market services. So what are market services? They're things that are very driven by wage costs. So they're domestically traded things that you can't import. The pressures in those types of services and the costings are driven by wages, and they tend to be very sticky. And this was really one of the themes of the month, sticky inflation. It's the same in the US. Sticky inflation is, if anything, picking up momentum. And sticky inflation, of course, by definition, you would imagine, is the hardest type of inflation to wring out of the system.
Yeah. Is it a lagging thing? Are we seeing the effects of other stuff? Does that mean it'll wring its way out of the system
Well, at some
eventually,
point in time.
Okay.
But before we get there, what it's done in the near term is it's caused rate cut expectations here to move from a November cut all the way out to a March, April rate cut.
And I saw
year.
NAB is projecting May.
I'm sure there are probably analysts out there saying that the RBA is done. So this is a risk we've been talking about for a little while, that expectations for rate cuts could be stymied by inflation stickiness, and that's what we saw during August. Sticky inflation, which is something the RBA cannot ignore. No. It's not going to disappear overnight. It's not due to oil prices and really cyclical. It's much more difficult to move than that. And this is the kind of thing that could prevent them from cutting rates. So market pricing's changed. Again, it's been moving in this direction, but that has already been reflected in the yield curve. It's already been reflected, I think, by the performance of Aussie equities during the month. And I think it's one of the reasons why the broader market here was slightly negative for the month. Yeah. That's the pricing in of a less and less supportive interest rate environment. And that is the risk in the rest of the world, that particularly in the US, 4 rate cuts, 2 this year, a couple next year, the risk is sticky inflation there, which we know is also occurring, is something that causes market pricing there to move similarly, which will likely have a negative impact on equity markets should it all come about.
And that leads us to the next thing, which is the economy itself. So the concern I have is that I don't want to be over dramatic, but it feels like the economy is on the cusp. And if rate cuts aren't forthcoming, then what we're going to get is a slowing economy. The economy is doing okay at the moment, isn't it?
Yeah, no, it's been picking up.
Yeah, but is that going to reverse, do you think? If we push rate cuts out to May, even, what happens then?
It'll be interesting to see perhaps what happens with house prices. So the most recent release for house prices shows another quite solid pickup, and we're now seeing momentum in dwelling values rising not only in the capital cities and all the capital cities, but also across key regional centres as well. So it's broadening out, and as well price increases are now starting to pick up a little more in more mid-priced dwellings, whereas up until now it only really been dwellings at the cheaper end of the spectrum. So that's a sign as well that the broadening in house prices is starting to gather more momentum as well. So the risk is that all the talk and expectations of further rate cuts, which is priced into what people decide to do today, that does run the risk, yes, of nipping some of this upward momentum. But as of today, housing prices do seem to have picked up momentum. It's broadening, as we said. Things like business forward orders have been picking up for a while as well, and that continued to be the case in the most recent months. So it's looking like the 3 rate cuts so far starting to affect the economy positively. Yeah, the risk is that if, because of inflation, rate cuts get completely discounted out of people's expectations, there is, yes, a potential there that some of this momentum might be nipped a tiny weeny bit.
And employment?
Look, employment's been a very strange animal. It's performed much more powerfully last year when the economy was much, much weaker. The reason for that was a lot of the employment growth was driven by public sector employment, particularly health related. So we had stronger employment last year in a weak economy. What we're now getting, somewhat bizarrely, but in a reflection of that, is weaker employment even as the economy's picking up. It seems like some of that is payback for the unsustainable strength in public sector employment. Now that's softening. It's softening at a pace that's almost taking out the positive impetus from private sector driven employment. So on the surface, it looks like employment's weakening, but I think what's happening is there's a change in composition. And they were changing engines, if you like, from public sector driven employment to private sector. But at the moment, the huge positive influence of public sector washing out is having a more negative impact than the private sector can really fill up, if you like.
And so, bringing you back to the share market, which is obviously important to us. So the big end of town, the top 100, has lagged a bit. The small company side has really starting to show continued resurgence. Is that consistent with what you're seeing? Is that reflecting of a slowdown in the broader economy but more opportunities in small companies?
Yeah, look, I think it is. I think it's also reflective of the fact that we've been talking for a while now that really the small ordinaries, the smaller part of the market has so underperformed the larger part of the market that the relative valuations were moving further and further apart. And at some point in time, you'd get a catalyst to start moving the valuations a little bit closer. And that's what happened in September and has been happening now for a little while. And we look at this from the point of view of the relative forward PE. Small ords are still trading at a greater discount than they usually do on average, but the size of that discount has just started to close. So that's in large part a lot of what we've seen in the last couple of months. It's a change in really the market's comfort and interest in smalls, and that's been reflected partly in a slight closing in this valuation gap. That could still have quite a bit of room to go.
And it has been led, although most sectors have done pretty well in small companies, but it's certainly been led by materials, hasn't it? Gold and silver have been on an absolute run.
They have been on an absolute tear, and we were saying earlier the gold price up another 10% in September, so that has only added further momentum to what had already been a trend well in place.
Okay, thank you, Rob. So let's talk about the outlook.
Look, we've said for a little while we're cautious. The reason we're cautious is the arguments we were talking about earlier, and that is just how much of the rate cut scenario will actually be forthcoming. It's all about the inflation constraints. We'll also overlay that and the potential downside risk there if the policy environment, the rate cut environment, is not as positive as expected, and or the growth environment is not a soft landing as expected. But we overlay that with valuation, simple valuations. We know valuations are toward the top end of their sort of historic range, and that's when there's potential for some of these negative risks to have a more significant impact when you've already got pretty high valuations and pretty high expectations for the forward earnings cycle. Again, in Australia, yes, valuations here are toward the top of their range, but it just seems that the underlying macro is moving in a better direction. The economy does seem to be picking up. We know inflation was a little bit stickier than the RBA and investors had hoped for, but the RBA has room to cut rates should there be any hiccups on the growth side, because they will likely, as you were pointing out earlier, with inflation, if we do get a hiccup in growth, you're likely to get inflation pressures ease, and the RBA then has the room to move a little more so to accommodate and try and cushion any potential downside. So broadly speaking, we're cautious. A lot of good stuff's been priced in. Here in Oz, there's room on the policy side to accommodate that either fiscally or from a monetary point of view, should things start to soften.
And that's where Australia is in a good position. It's got firepower should be needed. So there is some cause for optimism. And as you say, we're cautious, but there's levers they can pull to protect us. And I think that probably gives us comfort as investors. There's no doubt the market's expensive still. However, we're certainly not calling for an immediate downdraft or anything.
Yes, Steve, I think that's absolutely right.
Great, Rob. Thanks so much for your time. That brings us to the end of today's podcast. We looked at what happened in September 2025. We've had a bit of a chat about inflation and growth and the difference in markets. There's mixed views, but obviously in Australia's case, we've got the ability to protect the market, protect the economy with interest rate cuts if we need to. We hope you enjoyed today's podcast. Please subscribe so you don't miss out on future podcasts. Follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. Please do let us know if you have any questions or comments. And until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation or needs of any person and should not be considered a recommendation.